Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a senior manager here at Schwab, and this is long verticals and diagonals. And generally speaking, when I'm talking about options, probably one of the very most common questions I get is, Cameron, do you think we ought to roll this trade? What do you think about this trade? When might we think about rolling an option? And that's a great question. When might a trader consider rolling an option? Today, I think that our example positions in our paper money portfolio are giving us a couple of opportunities to talk about two very different reasons a trader might consider rolling an option, which is getting out of one and getting into another, just using the same order ticket for convenience. It's going to be a good discussion. I'm looking forward to weighing the pros and the cons of each of those decisions. Before we can get to that, though, let me first of all say hello to everybody out there in YouTube. Great to see Ricebird and Will, Willis, Steve, Tom, MB, Robert, Paul, Ted, Greg, everybody else. Thanks for joining us week after week. We really do appreciate your attendance and your contributions in these discussions. If you're here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the fact, enjoy the presentation, but be aware that you're invited to join us in the live discussion. This is a Thursday webcast series. Kicks off promptly 11 Eastern time. We'd love to have you here in our live stream audience. I also want to let everybody know that my very good friend Connie Hill is hanging out in the chats with us. She's another one of our great presenters. She brings a wealth of knowledge and experience to this discussion. And what Connie's going to be doing here for the live stream audience, she's going to be answering questions that I can't get to during just the flow of the presentation. As long as those questions aren't too far off topic, Connie's there to pick up my slack. So thanks for being there for me, Connie. And also, Connie and I would like to issue an invitation to all of you, whether you're watching live or you're watching on the archive. If you have an X account, make sure that you're following your favorite presenters there on X. You can follow Connie on X at Connie Hill CS. You can find me there on that platform at Cameron May CS. But that really is the very best place to connect with your presenters, your favorite presenters in between the live streams. So let's get into this. Very first thing that we need to do, of course, is to pause to consider the risks associated with trading and investing. Risk can certainly be significant, particularly in reference to options. So bear these important disclosures in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only. It should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as sole means of investment research. Investing involves risks, including the loss of principal, and any investment decision you make in your self-directed account is solely your responsibility. Okay, so let's set the agenda for the day. So each week in this webcast series, we kick things off by reviewing our current positions in our paper money portfolio. And actually those positions are what led me to think about today's discussion, because I do think there are a couple of examples of trades where a trader might consider rolling. Now, there are always pros and cons to rolling, so we want to give those a balanced treatment before we do our example trade here. But yeah, there are going to be two very different reasons that I'm going to be demonstrating rolling in our current positions today. So pay close attention to those reasons. Then we're going to take a look at the markets, and we're going to be adding an entirely new trade to the example portfolio before the conclusion of the session. So that's how we're going to proceed. Let's go right to Thinkorswim Desktop. This is the paper money software platform. And here are our existing positions from Broadcom right on down to United Health. Let's look at these 5 positions. So first of all, we have Broadcom. This is a long call spread. Bought the 220s, sold the 225s with a long call vertical spread. We prefer for the stock to be above our vertical as we approach expiration. In this case, that expiration is the 21st of February, 8 days from now. So we'd like to be above 225. And right now we're at 234. So certainly working in the right direction. Let me look at this on a chart. So we initiated the trade right back here. This one took some patience. Okay. Yeah, we took the trade. Things cooperated very nicely for about a week, dropped hard on the DeepSeek news, and then it's been in sort of recovery mode since then, but we're back up above our 2 strikes. The blue lines represent our 2 strikes. 220 is our long, 225 is our short. We're back up above that level. So the trade seems to be going just fine. We could look to possibly exit. I don't think we're quite close to, we're actually beyond about 50% of our original planned profit. Still with 8 days to go, though, there's work to do. I think I'm going to leave this one intact. So you can see right here, we paid about $3.35 to get into the trade, hoping to see that increase on a $5 wide spread. Well, optimally, theoretical maximum gain would be if we could sell this for $5 net between our two strikes. And right now it's closer to $4 and change at the moment. So getting there. But yeah, it looks like we're only about halfway to that maximum theoretical gain. I'm going to let that one continue to work, but obviously the risk here is we have a red candle today. If we get a few more of those, we might be out of max gain territory, could be down between the strikes, which presents its own set of dangers, or even get all the way down to max loss. So we're going to see what happens over the next week. Now, the trader who is managing this in their own paper money portfolio, maybe they're paying attention to this on a day-by-day basis because things can change rapidly. I don't have that luxury. I only make account changes while the webcast is live. So this one, we'll just have to see how it goes over the next week. So I'm going to leave that one alone. Broadcom, we're leaving it there. Cisco, what an interesting day for Cisco. Cisco was a low probability trade we took a few weeks ago where we felt a little bit more strongly that we could be in for a nice move upward on Cisco. So we went with an out of the money long call spread, a little bit more aggressive, higher reward, lower probability on that trade. Well, the probabilities have kind of been shuffled to the side. The reward has been the one that's been unrealized up to this point, but working its way toward realization. Stock has been cooperative. Let's look at Cisco. Was really cooperative this morning, but this is also an illustration of how quickly things can change. When I looked at our trade this morning, I thought, great, we're going to have a great discussion. And it's still an important discussion. So here was our trade. We took 44 contracts back here on, let's see, we initiated that on the 2nd of January. Pretty rapidly, we got a big move in the direction of the trade. So we're trying to get up above this spread, up above 62.5 is where we'd like to be. Pretty quickly, we got close to that, and we decided to take off a good chunk of that position. So we were already into profit territory. We were able to close 29 of the 44 contracts and recapture all of the initial investment in this trade. So from there, I wouldn't call it a no-risk trade because we can still lose the value of the remaining contracts, but it was a break-even trade at worst from there. So that bought us a little bit more patience, I think, when over the next 48 hours, we got a strong collapse in price. Then we went into recovery mode again, and we got right up into our max gain. So when I looked at this morning, I thought, oh, this is interesting. We'll have it look where we're looking at essentially maximum theoretical gain this morning. I think we've slid away from that a little bit as prices have sunk from hitting a peak up here. How high did we get? Up to 66.5. We've given back more than $3 down to here. Yeah. If we have another day like that, we could be straight out of maximum theoretical gain territory and even possibly right down into max loss territory. But let's go see how this trade is going. Bottom line, up about $2,000 on our 15 contracts. So we initiated this trade for a net of 90 cents. It's a $2.50 wide spread. So that left $1.60 in potential profit per share on 1,500 shares. So let's do some quick math here. So setting commissions aside, if we had $1.60 that could be made, and we multiply that by 1,500 shares, theoretical best outcome is a $2,400 profit. So are we all the way there? No. Are we 4/5? Are we 80% of the way there? That's about where we are right now. Yeah. Even with that big red candle today. So question becomes, if this were in your paper money portfolio, what might you do? Pros of, let's say, if we hang on to this, maybe this sell-off is just a fake out. and we recover, and we make the remaining $400 or $500 if we can stay in that maximum theoretical gain territory. As long as even if our short contract were assigned, we can exercise the long, still results in max gain. Okay, but yeah, if we're up here, we're in good position to make some more money, $400 or $500. But also, there's the downside momentum. We could continue that collapse, surrender even more of this morning's unrealized profits, maybe slide into loss territory, maybe even to maximum loss territory. I'm just going to close this one up. Let's right click on Cisco. Let's create a closing order and sell this vertical. Let's see how much we can get out of this. So remember, in for 90 cents. Let's see where we can exit. Right now, it's looking like maybe the mid, if we can get a generous fill, maybe 219, 220. I'm going to slide that closer to the natural. That would be in for 90 cents, out for, let's try for 210. That would be $1.20 profit per share on a 90-cent investment. Someone is proposing, Leon, somebody saying roll. Well, not going to be rolling this one, but we are going to be rolling at least one of our positions. But let's confirm and send this order. Going to try to sell. I say try because this is a limit order. Limit order is not guaranteed to fill. We're going to try to sell our 15 verticals at a 210 limit minus commissions. That would leave us with $31.30 net credit. The original cost, 90 cents times 2, was a $1,450 trade. So or not times 2, times 15 contracts. Anyway, but let's send this order off and see. Yep, out at 216. Okay, it's not 250, so that we left 34 cents per contract. So what did we lose there by doing this? We've lost the potential for getting $34 per contract times 15, left $500 on the table. So it's not perfect. Is it a perfect exit? Nope. Was it a profitable exit? Yes. Okay. There we go. So Cisco off the table. That one's banked. Let's circle back to Gilead, because that's one of the ones that we're going to roll. We do have a position in Microsoft. This is a long call vertical that was just recently taken. As we click on the quantity here, it tells us this was last week's trade. Okay. Bought the 395s, sold the 400s. We'd like to be above $400. We're above $400 right now. And you might think, well, shouldn't that mean that we're in profitary? No. We were further above 400 when we started the trade. So here's what's going on with Microsoft. We took the position right there on an apparent bounce off this recent support. Well, notice we've come back down there, sort of teasing that support. Our strikes are still down here. We're still in maximum theoretical territory, maximum theoretical gain territory. It's just that we're not as deep into that territory. That's why we're sliding down from profitability. But it looks like we're still holding that support. I'm just going to leave this one and let it work. It's only been a week. We're still above support. Let's let it go. Now, our final two positions are what I wanted to talk about today. We have Gilead and we have United Health behaving very differently. Both of these are long call diagonal spreads. So with Gilead, we bought the 95 calls for 2027, June of 2027. Those have 854 days on them. But this 21st of February call, we sold the 100, pardon me, sold the 100 calls. So the preference for this trade is for the stock to go up. That helps out our long calls, but hopefully to stay below 100 so it minimizes the risk of assignment on the short calls. Well, we've gone up, but we haven't stayed below 100. We've actually popped up to 105. Look at that, on the nose, to the penny right now. That's where the mark or the market price of the underlying is right now. So here's what it looks like on a chart. There we go. So this green line represents our long calls. Those are doing great. This red line represents our short calls. Not so good. So we are more profitable on the long than we are unprofitable on the short. But what's the problem right now? We're 8 days from expiration. We are $5 deep in the money. What just went up if we consider this a risk of the trade? Assignment risk. Yep, could happen at any time. In paper money, it doesn't happen before expiration. That's very different from real life. But yeah, someone has the right to buy shares from us for $100 per share, and those shares are worth $105 right now. They could buy them, sell those shares for $105. Now, even that might net them some money on the shares. They'd still have to surrender remaining value in their call. That kind of lowers the risk of assignment, but early assignment is now elevated from where it was. That risk is elevated. So I think what we might do here, I'm going to roll this $100 short call. Let's put ourselves in the shoes of the trader who's in this position. Maybe they just don't want to be assigned. Assignment here would create a short stock position of 300 shares in this case, because we did 3 contracts. So rolling, if you're not familiar with that terminology, it's a trading term meaning get out of one trade into another trade using the same order ticket. That's basically what it means. Now, unfortunately, what I would call them, if you'll forgive the term, hucksters. People will turn that into a magic term, like it fixes the original trade and magically replaces it with a new trade that's going to make everything okay again. Nope, the new trade has its own distinct, unique risks and advantages from the original trade. When we roll from one trade to another, we either made a profit or we made a loss. That doesn't change. Maybe the new trade, because that becomes a realized gain or loss, in this case it's going to be a realized loss, the new trade may wind up generating profits of its own that might exceed the losses on the original trade. That's a story yet to be told, though. All right, but let's go. Here's what I'm going to do. I'm going to exit this short call. Here, let me right click on this drawing, this line. I'm going to move this up here to 105. Pull this out to the next month. So instead of being in a 100 short call through the 21st of February, we're going to go up to a 105 short call through the 21st of March. So let's activate this drawing, push it up there, and we're going to edit the properties of that drawing. Let's call it the 105. There we go. So if you can see what we're doing here, is there still risk of assignment? Yes. This would now be an out of the money short call with a long time to expiration. The owner of that call will have they'll have less motivation to assign. They still could. Even an out of the money contract can be assigned. But we're going to nudge that up there. We're going to keep that long call because it's doing fine, has lots of days left. So I'm going to right click on this original call. Let's create a rolling order, and it's going to say sell a calendar. Yeah, that's sort of what this is. But what this does is it creates an order to buy back the short calls that we're already in. That's the 100. It doesn't know which contracts we want to sell, so it just brings up the next expiration. I'm going to push this out to the 21st of March, roll that on up to the 105 call, and look at this. This is going to be a debit trade. Oh no! Isn't that terrible? There are some people that say, I only roll if I can get a credit. That's because in their minds, there's logic to that. They know that it's costing them some money to get out of this February call. And what they're hoping for is that the premium collected on the next one is enough to make up for this trade if it goes well. Well, that's nice if that trade works out. But there are typically a couple of ways that we can increase the credit being received on the new option that's being added to the portfolio. We can go further out in time, thereby dialing up the risk for, more time equals more time for things to go wrong, is one way to look at that. Or we could go further in the money and create a larger risk, which creates a higher risk of assignment. But yeah, it generates a credit. So that which is, if it works out, that's great, but it might not work out. And actually, pursuing credit at all costs can actually really just open the door to just adding bad trade to bad trade. It lowers the probability of success in many cases. So in this case, sometimes is it maybe better to just say, you know what, this one didn't work out. Maybe this short call is one of those where we just lost some money. Yeah, that happens. Now, if we focus too much on that short call, we might lose sight of the fact that we, at the same time, own a long call that's actually doing great. Just before we submit this trade, I just want to show you this. Yeah, our short call, we sold it for 113. It's worth $5. That's going to be about a $4 loss if we roll that right now. I don't have anything in my power to change that fact. But our long call, we bought it for about 16. It's worth about 22. We're actually up $6 on that. So overall, this is not an unprofitable trade. Okay. Scotty B says, why not go to a 110 on the short? We could, Scotty. Yeah, we could go a little bit further out of the money, give that stock more room to the upside. That could be a pro of doing that. What would be the con? Not as much premium. Yeah. But in some cases, it may be healthy to just treat the two roll transactions, the one that we're closing and the one that we're opening, for the different trades that they actually are. So if you want to see the chain here, let me minimize this order for just a moment so you can see what it's doing. So we know that the 100 is priced about $5. You can see that, 495 to 515. So for traders that insist on a credit, let's see what they might have to do. If they go out to the 21st of March and they go up to 105, they're only getting, a little less than $3 for that. They might have to go still with the 100. Well, that leaves us with the problem. We're still $5 in the money. And if assignment was a risk, we've maybe minimized we've reduced the risk a bit, but it's still in the money. Even out of the money contracts can be assigned. I can't, stress that enough, but it's just not as common. Or maybe they push this out further in time. Could the 17th of April at the 105 get us enough? Nope. Could the 20th or 16th of May at the 105 get us enough? There we go. Maybe we could squeeze out a credit going out there. But that leaves us in a short contract, not for 8 days, not for 30 days, but for 92 days. Okay? Oh. So there we go. Hope you get the point of this. A roll is not a magic Band-Aid that makes everything better. It doesn't wipe away the boo-boo for the trader who doesn't like to take losses. It can, rolling for credits can be good, but we have to also assess the risks when we're doing these things. Anyway, sorry, voice is struggling a little bit today. Let's go back to our trade. Let's bring that back up here. Yeah, so in this case, it's going to generate a debit. Maybe we can minimize the debit, try for the mid. I'm going to say we're willing to accept a little bit larger debit here. Let's lock that in, see if we can get out for 240. I'm going to click confirm and send. Let's try to sell this. It's labeling it a diagonal, but we know it's basically getting out of the one position that we're already in into another. There are going to be commissions to do this, and let's send this order off. And I want to see how this fills. If it fills, let's let it work for a second. It's up here in our working orders. We'll come back and revisit that in just a moment. But while that's working, it looks like we're right there. I might have to dial up that debit. Let's right click, cancel and replace that order. Let's say we're willing. Yeah, it's moving on us. It might even take us 250. Confirm and send. Still that commission to consider. Let's send that order off. So while we're, okay, there we go. We just got out, sold it at 247 debit. In other words, we probably got somewhere in the neighborhood of 250 for the new call that we just sold. We probably got out somewhere in the neighborhood of about $5 for the call that we bought out of. So did we get a credit? Nope. But does the new trade still have its own potential for profit? Yeah. Yeah. It can make up to whatever it filled for, 250-ish. And we can start to hopefully add profits to the unrealized gain that we already have. Let's not lose sight of the fact that the trade is still going fine. It's still, the long call is still doing fine. So now let's all make ourselves feel better. Jay says, is this covered call? No, we don't discuss covered calls in this webcast series. That one was a long call diagonal, which ironically some people refer to as the poor man's or the poor trader's covered call. Yeah, we've actually titled one of our webcasts recently. But let's look at UNH. UNH, I wanted to talk about rolling this for an entirely different reason. Still a long call diagonal. We bought the January of 2027 520 calls. We sold the 21st of February 2025 short calls. So with this trade, we prefer for the stock to go above 520, but to stay below 560. Well, it's kind of done that. Here's what's happening with UNH. We took our trade right here. And what we'd like is for price to go up, helping our long call, but stay below 560. Well, it's sort of waffled its way up. It hasn't actually gained much territory. We've done about that. Has that helped out our long call? Nope. The time decay in that long call has actually offset any gains in delta of our long call. So our long call's underwater a little bit. But our short call has made up for that loss plus some. This 560 short call. So our long call, yeah, we're down about what? About $4.50 on that. But our long call, we're down about $4.50. Our short call, we sold it for $9.50. It's only worth 87 cents right now. So we have an unrealized gain close to about $9 there. Shall we? How about we do this? Let's realize that gain. Here's what I'm going to do with this position. Very different motivation. This has a very low probability of early assignment. It's way out of the money. But there's just not much juice left in it. That's a different reason why a trader might consider rolling. In this case, they're rolling because the trade has essentially, with the short option, gone so well. Yeah. So here's what I'm going to do. I'm going to roll this one out. This short call is going to expire February 21st. I'm going to carry that out to March. Let's get into a new call further out. That allows us to maybe get a bigger credit. Since this one's pretty much dried up, let's activate this drawing, and I'm going to drag it down here to, how about we look at, I don't know, should we look at this 550? That looks like that's still been a pretty decent area of prior support. Could be a new resistance. It's lower. So what we're doing here is we're not giving our trade as much headroom as it originally had. That's a trade-off here. But I'm going to edit the properties of this. We're going to bump this down to the 550 call. And let's move it down. There we go. That's what we're going to do. So we have this much headroom. We're down here at 530. Hoping to stay below 550. The advantage here is maybe we can get out of this call that only has 86 cents or around there of juice left in that trade. How much could we get if we go out to the 21st of March? 550 call is back around that 950 level. So we might, in this case, yes, be getting a credit of about 850. Let's do that roll. Let's go to our monitor tab. I'm going to right click on our short call. Let's create a rolling order and sell. It's just one calendar. We just have one, and we're going to diagonalize this anyway. But this is in order to get out of the 560 call that we're in. Let's get into a March 550 call. Yes, there's a credit. Let's say we're willing to settle for a little less credit. How about we go for 850? And let's click confirm and send. So this is calling this a diagonal, but again, it's just exiting the one, using the same order ticket to get into another. There is a commission to get out and get in. Let's send that order off and see if we can get, oh, look at that, sold immediately. Okay, we've now realized about maybe an 8.5 to 875 gain on the February short calls. And now we're into a March trade that might continue to contribute profits. It's also a trade that could go south on us. So the thing that I wanted to discuss today, a few items when regarding rolling options. Number one is there can be a number of reasons why the trader rolls an option. It might be because the trade isn't cooperating. It might be because the trade is cooperating. In both of these scenarios, though, they're both long call diagonals. At their basis, at their most basic, they're bullish trades. If our trader here had decided, you know what, I think this thing's just going down, in that case, they may consider just exiting the trade entirely. But in both of these cases, the stocks have been kind of cooperative to the upside. So we're going to leave those in. But yeah, a bottom line here for both of those is that the new position carries its own unique reward potential, its own unique risk potential. And with rolling, we tend to lose sight of the risk side of the equation. If I roll for a credit, I've somehow made up for the loss. No, we haven't. Nope. There were probably additional risks taken in order to generate that credit. All right, so we'll see how those go. But we've managed our existing positions. I would normally do that in the first 15 minutes of the presentation, but I wanted to give more time to that rolling discussion. But let's add a new position to the portfolio. Sunita says, as our long call is in 2027, why are we doing such short calls so close to expiration? Can we go further out, maybe get a higher credit? Yeah, and I discussed that, Sunita. Going further out in time can generate a larger credit, but actually, on a day-by-day basis, there is an anticipation of less reward potential in a longer-term short contract because time decay is slower, which is the one variable that one can predict to a high degree of certainty in a short option. Now, obviously, Delta, Vega can offset that time decay, but the one thing that's working that's sort of in the favor of the trade is slow on those longer term options. So the per day trade-off, traders might be looking for a balance there, and they may look to get into a shorter term trade, and then collect. Yeah, it's a smaller credit, but when that credit's done, that gives us more time to do another higher return on a daily basis trade. I hope that made sense. Anyway, so let's add a new position to the portfolio. A couple of things that we've discussed in selecting a new position. Number one, what kind of stock? For some traders, they consider the price of the stock. They consider the liquidity of the stock. Let's look at one of the higher priced, not higher priced, but one of the most liquid stocks out there. It's one of the biggest companies in the world, Amazon. Another thing that a trader might look for if they're technically oriented is what's going on with the chart on a stock. And Amazon has been making higher highs and higher lows for about 7 months now. And it recently pulled back about proportionately to other pullbacks. And that looks like it's put it in alignment with an upward sloping trend line, possibly with an area of support. This doesn't guarantee that price is going to rally from here, but let's say that our trader thinks that it is. So a decision that might be made is, well, if we're about to put a new trade in our portfolio, is it going to be bullish or going to be bearish? I'm going to be doing a bullish trade for today, and that's because of this outlook. Let's have a look at the S&P 500 before we go put on our Amazon trade. The S&P's had a great 12 months. It's recently sort of consolidated. What do we call this? When the highs are going lower, lows are going higher on a chart. That's known as a symmetrical triangle, which some technical traders interpret to be just a pause point. And then the assumption is that whatever the trend was before the pause is likely to continue. Time will tell if that turns out to be the case. But let's just say that our trader thinks the S&P is in a symmetrical triangle coming out of a bullish trend, maybe they think we're likely to go higher. So we're going to be putting on a bullish long vertical today. Also, the trader might decide whether they want to be relatively aggressive or relatively more conservative as far as the reward potential of the trade is concerned. And that might relate to their convictions regarding the markets. If they're really bullish on the markets, maybe they get more aggressive with their long verticals and go possibly out of the money. If they're not quite sure, maybe they get a little bit more conservative and they go more in the money. So settling for a lower reward, but a higher probability on the trade. I'm going to say that our trader has sort of that outlook. Let's go a little bit higher probability with our Amazon trade. Oops, meant to go here. So with Amazon settling down around that 228, I wonder what we could get if we were to structure a vertical, maybe down here at the 225-ish level. Let's put one out there to the 21st of March. We already have some expiring in February. So let's go to the March contracts. I wonder what we could get into at the 220 and the 225 strikes. Let's go to our trade tab. 21st of March, 220, 225. You know, there's a 63% chance approximately. Delta, one of the uses of Delta, it can tell us the leverage on a contract, how much it could make or lose on a $1 move in the stock. It also can give us the relative likelihood that a contract expires in the money. And that's just what we want out of these trades. So maybe about a 63% probability of success on this strike pair. I think we're going to do that. Carol, hey, you're certainly welcome. We're going to buy the 220 call. Looks like it's going to cost us, about $13.50. But that gives us a right to buy shares at 220. Then we're going to sell the 225 call, which has us in an obligation to possibly have to sell the shares for 225. Well, if both of those contracts get assigned and exercised, we buy shares at 220, sell at 225. That'd be a $5 profit on the stock. So it just comes down to how much does it cost us in options premiums to set this deal up. Let's see. I'm going to go up to spread single. I'm going to change that to vertical. There's our 220, 225. Looks like it's between 3.25, 3.5. Let's assume that we pay 3.5, somewhere around there. I'm going to click on that and do a quick calculation as we place this trade. When we buy this vertical spread, let's see. Yeah, let's dial this up. Let's say we're willing to spend all the way up to the $3.5. Okay, that's $350 per vertical. So in this webcast series, we typically keep our investment down under $4,000. 10 of these would be $3,500. 11 would be $3,850. Let's do that. 11 of these. So as we're buying these contracts, just remember again, the right to buy at 220, obligation to sell at 225. The objective here is to get assigned, is to exercise. It is to see these contracts enforced. Yeah. Buy at 220, sell at 225. That's a $5 profit potential on the stock, minus the $350 to set the trade up, leaves us with $1.50 of reward potential. Let's click confirm and send. We're going to buy these verticals, try to get filled at $350. That will give us a max profit of $1,650 on our 11 contracts, max loss of $3,850. There is a commission to enter this trade. Let's send that order off and see if we get a fill. And while that's working, I think, yeah, there we go. We filled at $340. Okay, so $3,400, actually $340 per contract to get in. That'll leave us with $160 in profit. But as we look at this on our chart, here's what we want out of the trade. I'll just draw in the facts of the trade. We entered on this day. We'd like our stock to be above our strikes. This is our profit zone. Anywhere above 225. There we go. That's our maximum theoretical gain zone. Right down here is our maximum theoretical loss. We can carry either one of those as high or as low as we want. Let's make this one red. There we go. But you can see why, for a trader who's maybe not as, maybe they're looking at the S&P and they're not quite sure that it's ready to make a strong move to the upside, so they're not getting really aggressive with the trade. Well, in this one, the way that we've structured it, we're already in the maximum theoretical gain territory. It doesn't really have to do anything to be in position at expiration for that maximum theoretical gain. It can go up, it can go sideways, it can even go down a bit. If it goes down too far, that's where we get into max loss. Jerry says, why not the 225, 230? Yep, so that would be up here, Jerry. That would be a little bit more aggressive. That would be if the trader, it would cost less, and it would carry higher reward potential, but it would be a lower probability trade. We can see that either on the chart, or if we come back here, we look at the deltas. So 225, 230 means we have to be above 230 at expiration, which has, about a 52% likelihood. That's sort of a 50-50 proposition versus, so we're going from about 2 out of 3 odds to about 50-50, 1 out of 2 odds. So is either one of those the right or wrong answer? No, it just depends on the convictions of the trader. Do they want to go for higher reward with lower probability or lower reward with higher probability? Great, good question. All right, but guys, we've actually accomplished what I set out to do today. We placed that trade. Let's pop that up into, let's move that to our long verticals and diagonals. So here's our new Amazon position, and we'll see how that goes from here. Notice it's a little bit underwater right now. That's always the case when we have a spread between the bid and the ask price on the long option and on the short option. It puts us a little bit in a hole to start off every option trade. That's why we try to keep that spread as narrow as possible. But we've accomplished what we set out to do today, everybody. Really, we wanted to emphasize rolling. What are the pros and the cons? What are some of the circumstances when a trader might consider rolling a trade? And we actually went through 2 very different reasons why a trader might consider rolling a position. But we also managed existing positions, and we looked at markets, placed a new trade. It's a lot to take in one webcast, but as always, you can go back, not always, not as always is a strong term, but as is more normal than not. You can find these webcasts on our Trader Talks channel after the fact. If you want to go back and revisit a webcast, or if you just want to go through a playlist. So what I would suggest, if you're not using our Trader Talks channel on YouTube to its full potential, go down right below the video right now, click on the subscribe button, and that'll subscribe you to the channel. But our channel is where we host our playlists. It's where you can join our live streams. Doesn't cost anything to subscribe, so definitely do that if you haven't done that already. Also, make sure that you're following Connie and me on X. If you have an X account, go to your account, find Connie, at Connie Hill CS is her handle there. Mine is at Cameron May CS, but X is the best place to connect with your favorite presenters in between the live streams. Find us and follow us. It doesn't cost anything for a follow, and it just gives you another educational resource. Hey, Connie, thanks for helping out in chat. Definitely appreciate it. I can see everybody, over 200 people watching, 77 likes. Thank you very much for that to your presenter. Clicking on that like button sounds like applause to your presenter. It's a nice little pat on the back for their efforts if you've enjoyed a webcast. And it gives the webcast a boost in the YouTube algorithm, helps us find a wider audience and help more people understand these concepts. So if you just make a habit, every time you watch a webcast and you do enjoy it, click that like button. Definitely appreciate it. All right, everybody, thanks. I will see you in a future webcast. Perry is asking, are we on any other social media platforms. Nope, that's the one. So if you want to connect with your favorite presenters, X is a place to do it. But I'll see you at a future webcast. I have something new every day of the week. I'll also look for an X, but whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.